All right, I'm recording a video here. This is my first in my series of daily insights. So I'm going to give you a very quick introduction to myself and then talk about what I'm looking for in the market today. I intend to do one of these for at least the next week or two and see how it goes. I won't go into everything today. There's a lot of stuff to cover. So let's get to it. So as a trading cat, I'm quite familiar with macro, technical analysis and fundamental analysis, but I tend not to use it day to day. To me, it's sort of like a bit of a backdrop. I tend to work on price action, sentiment and positioning. And this is quite different to most people. So hopefully you find it sort of a different perspective. And I hope that, it complements what everybody else has told you rather than just repeats things you've already heard. So let's move on with what we've got on the cards for today. We've got the Canadian CPI data coming out at 1:30, and we've got the New Zealand cash rate coming out in the wee hours of the morning, GMT. We've also got Bailey from the Bank of England speak at 6 p.m. So if you're doing anything with commodity currencies, including the Australian dollar, be very cautious of this because you're likely to see some volatility around that time. Similarly, if you're looking for any pound trades around the Bank of England speech, be careful of this as well. So, continuing on, I'm just going to talk through what I'm seeing in markets at the moment. So, looking at the major currencies, the first thing to notice is we're in a clear uptrend. And in the market, there's three types of trading going on. There's the trend followers that you can typically see in the COT, and then there's emotional money that tends to be equal and opposite. And you can think of the emotional money as people who bet against the trend, and the trend followers as people who bet with the trend. And you normally find these two are kind of equal and opposite, and they're a lot more correlated than I think most people realize. Emotional money tend to take the same longs and the same shorts at the same time, and trend followers tend to take the same longs and shorts at the same time. So you can have a pretty good idea on when they're going to stop out and what targets they're going for, or when they might be increasing or decreasing their position. So given we're in an uptrend in the euro and the pound here, I would only be taking trades that are long euro and long pound, or long anything against the dollar. I wouldn't be taking any trades that are long dollar. And so even if a trade came up that sort of looked like it was a good long dollar trade against one of those currencies, I would sit on my hands and not take it. Generally, trends continue for much longer than anybody expects, and betting with the trend will tend to make you money, whereas betting against the trend will be an exercise in frustration. So if we have a look at positioning data, what we can, for say the euro to begin with, what we can see is that the emotional money is very short the euro and also very short the pound. And you typically want to be betting against the emotional money. The emotional money tends to be way too early to the party, and the trend followers tend to be too late to the party. That is, when a turn in the market happens, normally the trend followers are too late in reversing their positions, and the emotional money is already betting against it before it's turned. Both can make money. The trick is to try and follow the trend, but to get yourself out, before you reach that turning point. Once you reach the turning point, try and get out with as little pain as possible. So in terms of a filter for my trades, I'd only be taking trades today and so on that are long euro, long commodity currencies, long pound, etc. There is one exception. I think the currency to watch at the moment is the yen. And I say this because the positioning on the yen is not really extreme either way. So it's definitely on the shorter yen side, meaning, you should be betting, on trend continuation. But it's not extreme. The market's been shorter yen many times before. So, there's a bit of ambiguity. I think a lot of people are sort of wondering how long this yen trade's going to go on for. And maybe they're starting to sit on their hands a little bit rather than shoot for the goals. If we jump on over into the yen crosses, what you can see is that all the yen is in a downtrend. All of these are the yen against other currencies adjusted to be all up the right way. So you can see that The yen is in a downtrend. However, if I sort of use my monkey/lizard brain and just look at the chart, to me it looks like it should be short. And often when it looks like it should be, is the time when everybody's already short and it's given you the fuel for a push higher, as any shorts need to capitulate and buy back their positions, pushing the market higher. And we call this a squeeze. When we look at the yield differentials between the two currencies, what we find is there's a huge divergence here in the last week or two against the yen pairs. So say, for example, here, this orange line represents the yen interest rate against the Australian interest rate. And typically, these things tend to follow each other. And where you get this divergence, it's normally a sign that, the trend's about to turn or something's about to change. So, I wouldn't be surprised the next week or two to see a radical push higher in the yen, i.e. a push lower in US dollar yen. So, I think that's certainly one to watch. We also have, various news points coming up for the yen as well. So, yeah, to me, the crosses that I'm interested in at the moment are the yen, just because the position is a little bit ambiguous. And I think given this trend's gone on for so long, at some stage it will reverse. Trees don't grow to the sky. To me, this looks like an interesting place to start looking for a squeeze. And it may be that the Bank of Japan surprises us with some intervention or a change of policy that sends the yen screaming higher. And everybody who's become accustomed to this following the trend down gets the shock of their life. I don't want to be buying the yen before this has happened. I need confirmation that the trend has turned before I get into that. So moving on to yields. Look at the 10-year yields. Again, when running higher in the 10-year yields. A few things to comment there. The first is the yield curve's inverted at the moment. Short rates are about 5%, depending on what currency you're looking at. And that means that if the yield curve were to uninvert without the short end moving higher in terms of rates, you could easily see this 10-year rate go up to 5, 6, 7% in order to uninvert the yield curve. So, I think for the time being, we need to assume yields are moving higher. On top of that, we've had very foolish policy decision from the European and American central banks who have decided to default on the Russian central bank because they're not winning their proxy war against Russia to try and remove a former Russian state. What the media is telling you about this is complete bollocks. There's a whole lot more to that story than meets the eye, but suffice to say that capitalism is built on trust, and trust, economic expansion is accelerated with the addition of debt. Debt is dependent on the money being paid back. So, if you lend money to a counterparty, that's still a debt and still should be paid back, whether you like the person or not. The moment you start saying we choose not to pay you back because we're not winning in our war against you to try and take control of Ukraine, you create a dangerous precedent. So, if you're the central bank of Turkey or India or even China, you would be divesting yourself of treasuries, i.e. getting rid of all your treasuries hand over fist because the US can't be trusted to pay you back. They've sent a clear message to the market: we're not trustworthy, lend us money and we probably won't pay you back, or we'll only pay you back if we agree with everything you do. And that's not the way capitalism works. It shows an extreme lack of integrity and a profound lack of understanding of the way debt markets work. So basically, as these foreign countries and asset managers and central banks divest themselves of treasuries, that creates an excess of treasuries, pushing yields higher. And the final of 3 points why yields are likely continuing moving higher is we're suffering stagflation, and the economic growth is in nominal terms strong, even though it doesn't feel particularly comfortable. And when you're at full employment with relatively strong nominal growth, you should expect yields to continue to be high or move higher. So that's yields. Looking at precious metals, gold and silver have been screaming higher over the last few months. I think a lot of this is to do with, again, that foolish decision by the Politburos in Europe and America to default on their debt obligations. So anybody with common sense is getting rid of money debts that they have with the US government and cashing those in and buying gold, silver, etc. To me, it's a no-brainer. So, I think it's no surprise that we're seeing yields move higher at the same time as gold and silver. And, another thing about this too is I'm not seeing a whole heap of hysteria about gold and silver yet, which is normally a good sign that a trend has further to run. I wouldn't be surprised given the huge deficit spending and the highly irresponsible policies of Western governments and their willingness to engage in wars and provoke, China, Russia, and the Middle Eastern countries, all of these things spell higher gold and higher interest rates. So, for the time being, I think, that's a reasonably safe bet to bet that, there's going to be more geopolitical turmoil, more short-term decision making by governments rather than thinking in the long-term best interests of their citizens, and so on. Silver's kind of like leverage gold. It's done really well recently, and copper's a very good read on the nominal growth of the economy. This is really quite astounding how much copper's run recently. It's in many ways also copper is used as an industrial metal, especially for electricities or anything that's thermal. So, it's suggested that there's not going to be enough copper produced to supply the needs of the people who want to go net zero. So that's incredibly bullish for copper. On top of that, in fact, I'd say more generally that there is no argument that's more bullish for mining than net zero. If we want to accomplish some of these net zero goals, we're going to have to dig the hell out of Mother Earth. The whole, basically the industry that benefits most from net zero is mining. And that's sort of it's sad, but it also shows limited understanding on the people who are making the policies. You can't build EVs without copper and lithium and cobalt and nickel, and so on. And recycling these metals, especially lithium, is very, very difficult because when you recycle metals, you typically melt slash burn them, and lithium is incredibly flammable, so it tends to burn off very quickly. So that's precious metals. Looking at the equity markets, I'm only going to cover the S&P 500. We're in this sort of frustrating time at the moment. We're in a slow melt up. And the reason why we're in a slow melt up is because basically the emotional speculative bulls don't want to buy when the price is at the top of the chart. So they're sitting on their hands. And the bears are looking at it going, it's going straight up. I've tried betting against this the whole way up and I've lost money. I'm going to sit on my hands now too. So neither the emotional bulls or the emotional bears are playing ball at the moment. They're both out to lunch and just waiting for a better time. And that's why if the speculators on neither side are playing ball, we're getting very, very low volatility. And the thing about this sort of market is it's a melt up, it's a slow grind higher. You might get 10, 20, 30% basis points higher every day until it stops. And when it stops, you're going to have a big move the other way. So, we may find that this goes on for the next 2 or 3 months, or it might stop today. Um, be very careful if you're going along this market because, with implied volatility very low and the implied volatility of implied volatility very low, there's a lot of gasoline there, a lot of dry powder for VIX to spike higher and equity markets to fall and that to feed on itself. Should we get news that the US has decided to invade Iran or put more troops on the ground in its war in Ukraine, etc. So, if a shock were to hit the market, um, you know, you might find you were comfortably making 10, 20, 30% basis points per day on the S&P 500, and then you're going to lose 300 or 400 basis points to the downside. So very much like picking up nickels in front of a steam train. So again, just to recap, be very careful with the S&P 500. It's going up for now as a slow grind higher, but you need to be able to walk away or run away from that market if you're long and something hits the tape, or even before something hits the tape and it all starts going pear-shaped. Like I said, don't know when that's going to be. Could be a few months off. But implied volatility and implied volatility of volatility are both very low, which suggests that when we do get a shock, it'll probably be a good run. The final thing too is we're coming into the final days of a full moon. or full moon in a couple of days. Typically, you get more volatility around the full moon and less around the new moon. This isn't astrology. This is to do with we don't sleep very well when it's full moon, and we tend to feel anxious and restless. As hunter-gatherers or subsistence farmers, we tended to do our farming, etc., according to the lunar cycle. And also, it's no coincidence that females of our species have a approximately lunar cycle as well in terms of their body. So, the lunar cycle is actually incredibly important, and there's correlation there around the moon. It doesn't necessarily mean that every cycle it's the same, but typically you want to be selling vol after a full moon and buying it into the full moon. Haven't really seen it this cycle, but it's definitely something that tends to persist. Anyhow, I hope you've enjoyed the video today. Just a quick disclaimer, none of this is trade recommendations. I'm not responsible for any losses that you make. It's entertainment, not advice. And finally, make sure you enjoy the journey. Have fun with it. Don't take it too seriously and don't leverage up too much.